Welcome, dear traders. It's me, Kate Stichina, and you're watching a recap of the Asian session. Sentiment on the Wall Street improved following the release of the US non-farm payrolls data. Stocks in Australia and in New Zealand rose as well. Another piece of good news came from China. The country is fully reopening its borders after a 3-year lockdown. Trading floors are closed today in Japan on the occasion of a public holiday, and this is why market volatility in the morning was subdued. Let's discuss what is going on forex. The non-farm payrolls report provided several hints about the state of the economy. To start with, the average hourly wages declined to 4.6% from 4.8%. It might be the first sign of an imminent recession. The PMI services index also dropped. What's more, factory orders shrank as well, providing more signs of an economic slowdown. However, the labor market remains tight, signaling economic resilience. Unemployment decreased in December. Job openings rose to 220,000 from 2,000 in November, and the majority of traders are betting now on a smaller rate hike at the next Fed meeting. According to the FEDWATCHTOOL, about 3/4 of speculators expect a 0.25% rate hike. The Fed will announce its rate decision on February 1st. However, several policymakers have already provided contradictory comments on the upcoming rate decision. Downbeat economic reports published on Friday fueled recession fears, and for this reason, some Fed members became less hawkish. For example, Chicago Fed President Charles Evans believes that the watchdog could hike the rate by 25 basis points at the next meeting. At the same time, Richmond Fed President Thomas Parkin assumes that it's necessary to continue raising rates until inflation returns to the 2% target. Atlanta Fed President Raphael Bostic noted that the recent signals on the price pressures have been moving in a positive direction, so the US economy is slowing down. Fed Governor Lisa Cook assumes that inflation remains far too high, despite some encouraging signs lately, and is therefore of a great concern. Kansas City Fed President Esther George fears that inflationary pressure could resume due to rising fuel and food prices, while traders are digesting mixed comments from Fed policymakers and fresh economic reports. The US dollar is sliding down across the board. In the Asian session, the US dollar index dropped to 103.5 versus its rivals, extending its losing streak that began on Friday. In the morning, it was moving in the range of 103.40 and 103.90. As a reminder, nearly 60% of the world's central bank's foreign exchange reserves are invested in dollar-denominated assets. The share of the US dollar as a payment currency worldwide is more than 40%. Almost all commodity contracts are priced and settled in dollars. Apart from that, it makes up more than 60% of international debt and 50% of loans globally. Therefore, the depreciation of the US dollar may have unpleasant consequences for the whole world. Low-income countries will surely bear the brunt. The yield of a 10-year US government bonds contracted along with the US dollar. As a rule, the yen appreciated amid falling US treasuries, so in the morning it made an attempt to dip below 132 and even 131.50. However, the US dollar climbed and the pair rate rose to 132.10. However, the pair is likely to remain flat today as the Japanese markets are closed. Therefore, it's likely to approach the range of 131.30 and 132.40 amid the volatility of the greenback. The yen may regain ground thanks to recession fears in the United States. Moreover, Japanese Prime Minister Fumio Kishida could also prepare the ground for an exit from the soft monetary policy. He hinted such a possibility on January 8. The regulator could start changing the monetary policy parameters in April when a new Bank of Japan governor is appointed. The government may also revise its 10-year-old accord with the Bank of Japan. Fumio Kishida said this when commenting on the further steps of the government to combat deflation. There are lots of positive fundamental factors for the Aussie today. The US dollar is sleeping, China is opening its borders, and besides, the Spring Festival is ahead. It will begin on January 22, and this is the most important holiday in the country. For this reason, analysts expect an increase in the sales and orders. Robust trading activity in China is bullish for the Australian dollar. Beijing also eased some restrictions on the export of Australian coal for the first time since 2020. And the Aussie also scored gains following the Reserve Bank of Australia's monetary policy decision. The next meeting is scheduled for February 7. The prospects of a rate hike could help the Aussie to assert strength against the US dollar. The AUD USD pair advanced to the range of 0.6876 and 0.6948. By the end of the Asian trade, it rose to the psychologically important level of 0.6930. These are the main highlights of the Asian session. Mixed sentiment, recession fears, and the hopes for smaller rate hikes are fueling volatility. It may increase even more following Jerome Powell's speech at the Jackson Hole Symposium and the fresh reports from the Eurozone and the Asia-Pacific region. And that's all for now. Stay tuned to keep abreast of the latest market news. See you soon.